You know, we've all been in a Best Buy, but have you ever stopped to think, is it actually a great business? Well, today, that's exactly what we're going to do. We're giving it a Buffett-style checkup, using a really simple version of Warren Buffett's value investing playbook to see what story the company's financials are telling us. So, let's dive right in.
It's really the big question, isn't it? With all the noise in the market, how do legends like Buffett seem to find value time and time again? Well, it all comes down to having a clear framework, a way to judge a business on its own 2 feet. And that's exactly our plan here, using Best Buy's own numbers as our guide.
So, we're calling this our Buffett-style checkup. And hey, a quick but really important heads up. This is purely for educational purposes. This is not financial advice. We're just learning how to take financial data and weave it into a story, looking at it through the lens of a couple of core value investing ideas.
And it really all boils down to 2 simple but super powerful questions. First, is it what Buffett would call a wonderful business? A high-quality, profitable company. And then second, is the stock selling at a fair price? Because hey, even a fantastic company can be a bad investment if you pay too much for it. Let's tackle that first question right now.
So, what even makes a business wonderful? Well, in plain English, it's all about profitability. How good is the company at turning $1 of investment into, well, more than $1? We're going to look at a couple of key numbers to figure that out.
First up is something called return on equity, or ROE. The easiest way to think about it is this. For all the money that you and I as shareholders have put into a company, ROE tells us how much profit that company is squeezing out of our cash. The higher the number, the better.
And check this out. Best Buy's current ROE is a whopping 36%. Now, to give you some perspective, a lot of value investors are looking for a consistent ROE of, say, over 15%. So right out of the gate, this is a pretty strong signal that Best Buy is a highly profitable machine. But, one number is just a snapshot in time. Context changes everything. As you can see here, while today's ROE is fantastic, it's actually just a little bit below its 3-year average of almost 38%. So that tells us that while things are still great, profitability isn't quite at the peak it was just recently. That's a really important little detail.
Okay, next up, return on invested capital, or ROIC. This is kind of like ROE's bigger cousin. It's broader because it looks at the return on all the money the business uses, not just from shareholders, but from lenders too. It's a fantastic test of how efficient the whole operation really is.
Best Buy's current ROIC is clocking in at over 20%. And again, that is well above that 15% benchmark that often signals a really high-quality business, maybe one that has what they call a strong moat or competitive advantage. So this is another really healthy sign for the company's core business.
And this is where the story gets really interesting. When we look at the history, the current ROIC is actually better than its 3-year average. That's a great sign of a recent comeback. But it's still trailing its much higher 5-year average. So this paints a picture of a company that's maybe getting its groove back, but isn't quite back to its prime performance just yet.
All right, so the numbers are pretty clear. Best Buy looks like a very profitable business. But that's only half the puzzle. Now we have to ask that second crucial question. Is it selling for a fair price? Remember, a wonderful business bought at a terrible price can still be a really bad investment.
A classic tool for this is the price-to-earnings ratio. You've probably heard of it as the PE ratio. It's just a quick way to see how the market is feeling about a stock. Basically, it tells you how many dollars you have to pay for just $1 of the company's annual profit. Generally, a lower PE can mean a stock is on the cheaper side. Now this chart, this tells a really powerful story. Best Buy's current PE ratio is just over 13. But look at the bars next to it. That is way lower than its recent averages. This is a classic sign that maybe the market is a bit down on the stock, which could mean it's being offered at a discount compared to where it's been trading recently.
So let's put a number on it. How does today's price stack up against what the company might actually be worth? Well, if we use a common valuation method, one that basically tries to figure out a company's value based on all the cash it's expected to make in the future, we get a calculated fair value of around $75 a share. With the stock trading around $66, you can see there's a pretty clear gap.
And that difference between the calculated value and the market price is what value investors famously call a margin of safety. In this case, it's about 11.5%. You can think of it as a potential discount or maybe even a buffer just in case your calculations are a little bit off.
Okay, one last test for us. A good business doesn't just make money. A lot of times, it shares that money with its owners, the shareholders. And a fantastic way to see if a company is doing that is to check out its dividend history.
Right now, Best Buy is paying a dividend yield of almost 5.8%. Just so we're clear on what that means, for every $100 you have invested at today's stock price, the company pays you almost $6 in cash every single year just for being an owner. That's a pretty serious cash return.
And this number, this one is all about consistency. 22. Best Buy has increased its dividend payment to shareholders for 22 years in a row. I mean, that is a powerful track record. It shows a real commitment to rewarding its owners through thick and thin.
But, and you knew this was coming, let's look at the trend. Over the last 5 years, that dividend was growing at a really healthy pace, almost 6.5% a year. But more recently, that growth has slowed way down to under 1.5%. So here's another one of those crucial details. The commitment to pay is there, but the growth of that payment has definitely tapped the brakes.
So we've looked at the quality of the business and we've looked at the price of the stock. Let's put it all together on a final scorecard and see what the whole picture looks like. Okay, to sum it all up, the numbers tell a story of a really profitable company with high returns, even if it's not quite at its absolute peak performance of the last few years. From a valuation side, it looks pretty inexpensive compared to its own history, and it seems to be trading at a discount to our calculated fair value. And last but not least, it's been a very shareholder-friendly company with a strong, reliable dividend. And that brings our checkup to a close. We've managed to build a pretty fascinating picture just from the numbers. But you have to remember, this is really where the hard work starts. The numbers can tell you what happened, but they can't always tell you why. And that leads us to the final and maybe most important question. What's the story on the ground? What's happening inside the actual stores? This data is the beginning of an investigation, not the end. I hope this was helpful. Thanks for tuning in.